What's my mortgage lender talking about? All these programs, conventional, government, FHA, VA, what does all of this mean? You don't need to know everything about each mortgage program, but having a broad understanding really helps in part of your plan. In part 2 of our First-Time Homebuyer Workshop, we're going to talk about mortgage programs. I am Peter Lindquist of the Lindquist team. We're going to talk about the broad brushstrokes of each of these programs so that when you're going through the pre-approval process, you'll have a basic understanding of what type of program you'll want to choose from. If you like this video, please be sure to give it a thumbs up, and you can always feel free to subscribe to our channel. We're always talking about first-time buyer stuff. And finally, if you've got any questions, place them in the comments below. I would love to hear from you. Okay, so mortgage programs can probably be best understood as two broad umbrellas. One of them is called conventional loans, and then the second one can be called government loans. Now, under the first umbrella is conforming loans, and these are actually the most common. The one that we're going to focus on is called conventional conforming loans. Those are loans that are sold to Fannie Mae and Freddie Mac. That's where the best rates are at, and fixed rate loans. There are other types of conventional loans like non-conforming, which are generally speaking jumbo loans, very large loans, like loan amounts over $766,000 currently, but that goes up every year. And there are non-qualified mortgages that have special considerations for borrowers that don't qualify under traditional means. And there are bank portfolio loans. All of those have a valid place in the mortgage market. But in this video, we're going to focus on conventional conforming loans through Fannie Mae and Freddie Mac. Now, these loans through Fannie Mae and Freddie Mac are both fixed rates and adjustable rate mortgages, though in recent years, fixed rate loans have been as good or better in terms of interest rates as ARMs, adjustable rate mortgages. Plus, most homebuyers, especially first-time homebuyers, like the predictability of a fixed rate mortgage, which is why it's by far the most common type of loans. One reason why buyers like this type of loan is that if you can put 20% down to buy the home, there is no cost for something called mortgage insurance. So we'll cover mortgage insurance in a future video, but mortgage insurance essentially is money that you pay to an insurer who pays off the lender's losses in the event of a foreclosure. Now, besides VA and USDA loans, which we'll talk about later in this video, conventional loans have the lowest down payment. Conventional loans will have down payments as low as 3% down. So that's 3% of the sales price, $300,000 purchase. That's a $9,000 down payment. And when you compare it to FHA has 3.5% down. So a little bit more required on FHA versus a conventional loan. Conventional loans offer programs that are called HomeReady and Home Possible. That's certainly something as a first-time homebuyer you want to be familiar with, because those programs can definitely save you money in terms of interest rate and mortgage insurance rate. And while conventional loans tend to be much more picky with regards to your credit and your credit scores specifically, HomeReady and Home Possible are not nearly as sensitive as other types of conventional financing. Now, there are maximum income guidelines for HomeReady and Home Possible. So if your income is over those maximum income guidelines, you would not qualify for the program. Conventional loans will go up to 1 to 4 units. So if you want to buy a duplex, triplex, or fourplex, all of those are possible. Anything above 4 units is not going to be a possibility using this program. Conventional loans have the option that you can put less than 20% as a down payment, but you'll pay for this stuff called mortgage insurance, which is actually a benefit because otherwise you wouldn't be able to buy a home using conventional financing. But unlike government products, mortgage insurance on a conventional loan can actually be removed once you achieve 20% equity in the property. That's one big reason homebuyers will opt for conventional financing if they're approved for it. But another big reason is that home sellers are much more likely to accept an offer that has conventional financing on it. And that's because of two big things. One is that conventional tends to be less picky in terms of the quality of the home, where government-insured loans might require to be scraped and painted prior to closing. Conventional loans do not require that type of thing. And the other thing is that home sellers will realize that getting approved for a conventional loan is harder than with government-insured loans, and therefore they perceive a conventional buyer as a stronger buyer. And then finally, conventional loans are most of the time the least expensive overall. When you factor in mortgage insurance compared to, let's say, an FHA loan, conventional loans are less expensive for many home buyers. Speaking of government-insured loans, we're talking about FHA. So there's three main programs: FHA, VA, and USDA. Let's talk about FHA first because it's by far the most common. This program is designed around first-time home buyers, but you don't have to be a first-time home. FHA loans tend to be much easier for a home buyer to qualify. Now, one of the big benefits to FHA is the minimum credit score is lower than on a conventional loan. So conventional loans minimum credit score is 620. FHA's currently is 580. And FHA, with regards to mortgage insurance, they charge it in two ways. There's a monthly premium that is actually not removable. Remember, I said on conventional loans, at a certain point you can remove it. You can't on FHA. They also charge mortgage insurance in a second way, which is called an upfront mortgage insurance premium called UFMIP. There's no maximum income limits required for FHA. Really, one of the only limitations is there is a maximum loan amount, and that is differentiated by county across the United States, and it changes every year. Now, the next most common is a VA loan. If you have this as an option, you would have to be a qualifying veteran in order for that to be the case. VA loans are almost always less expensive than any of the conventional or FHA options. VA does not have mortgage insurance premiums. They have something called a guarantee fee, which effectively does a comparable thing, but for veterans who have a VA-related disability, that guarantee fee is waived. So it is just a less expensive loan overall and tends to have interest rates that are comparable to FHA. Again, there's no maximum income limits, and the maximum loan amounts actually go higher than a conventional conforming loan. VA loans will go into the jumbo numbers, but above the conventional conforming limits, VA was going to require some form of down payment. And then finally, there's USDA loans. That's a zero down product, but this type of loan is limited by geography. It is designed for homes that are in smaller rural communities. So by that, I mean the USDA provides us a map that shows cities that are non-metro that have less than 20,000 in their population, less expensive than FHA. So if you're qualified for USDA and you have FHA as an option, choose USDA because the mortgage insurance premiums are lower than what they are for FHA. They tend to be pickier with regards to credit and qualifying because, you know what, you're putting zero down. So there's a greater risk, but if you qualify, USDA is a great program to try for. USDA is more limited in that it'll only do one unit properties, and it's got a minimum score comparable to conventional, so 620. The biggest thing about USDA besides the geography is they also have a maximum income limit. So for this program, we're going to look at all household income. Even for buyers who are not on the loan, we need to look at what their income is to make sure that they don't exceed the maximum income limits that are required by the USDA. So when it comes to pre-approval, it's really impossible to predetermine which of these products are available to you. Each of them have so many different variations and different kinds of guidelines. But generally speaking, if you're sitting down with a lender, it's a good idea. Hey, do I qualify for a conventional loan if the only loan is that they're offering you is FHA? Or if you are a veteran, hey, can you offer me a VA loan? You know, not all lenders offer them. So naturally, a lender is only going to focus on the products that they offer. When it comes down to picking a mortgage product, the best way and only way is also part of that plan. We go through the pre-approval, we show you the various options, and then you choose from them whichever one feels best for you. Thanks for taking the time to be with me today.